If you've ever wondered what the balance sheet is used for, this video is for you. Hi everyone, I'm Professor eMoney. I teach college level accounting and I'm here to take you through the balance sheet. The balance sheet is made up of a simple equation called A equals L plus E. Assets equals liabilities plus equity. Assets are things we own and they're at the top of the balance sheet. Liabilities are things we owe to others, like notes payable, accounts payable, and those are in the middle of the balance sheet. And then at the bottom is equity. This is equity as an owner that we have in our business, from money that we've contributed or stock that we've raised through outside investors. And so we're going to take a look at a sample balance sheet that I use when I teach my accounting course. So here we go. This is a sample balance sheet for a pretty basic company. And how do I know that? Well, when I look at the list of accounts, the only thing that's a little complicated is unearned or deferred revenue. That's something that most companies aren't going to deal with, especially small businesses and entrepreneurs, but it depends on your business type. But I see that there's owner's capital, which means there's just one account and that's one owner. So it's probably a sole proprietor who's, putting capital, which is cash, into their business for $70,000 to get their company going. And we see that we have a good amount of cash. We have $40,000. We have accounts receivable, notes receivable. So again, these are all of our assets at the top of the balance sheet. And the way we list those are in order of liquidity. Liquidity is the faster it can convert to cash, the higher it moves on the list. So if we think about it, well, cash is at the top because it's already in the form of cash. Accounts receivable is next, and that's typically true because accounts receivable turns into cash within 30, 60, or 90 days of collecting from your customer. So that's how we list our assets, and then we put in a total, and that's our A. And then remember, the bottom half of the balance sheet is equals L plus E. So our assets have to balance with our liabilities and equity. So if we look, we have liabilities that include accounts payable, wages payable, notes payable, again, the unearned revenue or deferred revenue, which most people don't have, but I will cover that in another video, and accrued liabilities. Accrued liabilities are things like attorney's bills that you know you've incurred the expense, but you haven't received the invoice yet. Those are things, again, this is a accrual-based balance sheet. You wouldn't have accrued liabilities on a cash-based balance sheet, and I have videos on cash versus accrual, so check those out. But the last piece is the equity, right? The L plus the E. And the equity is our owner contributions to the business of $70,000. Now that could be things that are non-cash items, but for most small businesses or entrepreneurs, they initially just put in cash. You can contribute non-cash items, and that can include inventory, machinery, equipment, any asset can be contributed to a business and then credited to capital. But again, most companies get started with cash capital. And so that's what I see here. I see a pretty healthy business. I see a business that raised its capital through equity, which is the $70,000, and that we have $23,500 in liabilities, but we have $93,500 in assets to cover those liabilities. So we're in very good shape. We can more than cover our upcoming liability payments, and because we have a lot in assets. And so this is a healthy balance sheet. In the next video, I'll be covering the income statement, and I'll continue to cover more videos. For those of you who can't come to college, I'll be dropping knowledge on my YouTube channel. Subscribe, like, and thanks for watching.